In today's video, I will be talking about 5 skills you must have to become successful or great at investing. Hello, and welcome to my channel. My name is Tony, and on this channel, I talk about investing, personal finance, business strategies, sales, marketing, real estate, essential money habits, and a handful of helpful topics on how to make money. And today we are going to be talking about investing. Before we get started, let's get to know more about the term investing and what it is all about. What is investing? Investing by definition is the process of allocating financial resources with the expectation of generating returns or income over time. Investing involves deploying capital into assets to grow wealth, preserve purchasing power, or achieve specific financial objectives. Okay, with that said, let's take a closer look at what investing is all about. Investing provides individuals with the opportunity to grow their wealth over the long term. By allocating funds to assets such as stocks, bonds, real estate, or mutual funds, investors aim to generate returns that outpace inflation and increase their net worth over time. Some investors focus on generating regular income from their investments. This can be achieved through dividends from stocks, interest payments from bonds, rental income from real estate, or distributions from income-oriented investment vehicles such as REITs or dividend-focused funds. Investing plays a crucial role in helping individuals achieve various financial goals, such as funding retirement, purchasing a home, paying for education, or building a nest egg for the future. By strategically allocating capital to investments aligned with their objectives, investors can work towards realizing their financial aspirations. By understanding investment principles, conducting thorough research, and maintaining a disciplined approach, investors can enhance their financial well-being and work towards realizing their long-term objectives. Alright, let's hop right into the next section of this video, which is investing skills. Investing skills refer to the knowledge, competencies, and abilities required to make informed and effective investment decisions in financial markets or business. These skills encompass a broad range of areas, from understanding financial concepts to analyzing market trends and managing investment risk. Let us also briefly take a look at how important investing skills are. Investing skills are essential for individuals seeking to build wealth, achieve financial goals, and navigate the complexities of financial markets. Developing and honing these skills through education, experience, and continuous learning can empower investors to make informed decisions and succeed in their investment endeavors. Here's a breakdown of key investing skills you must have. Skill number 1. Financial literacy. Financial literacy entails a fundamental understanding of financial principles, including concepts such as compound interest, risk-return trade-offs, asset classes, investment vehicles, budgeting, saving, debt management, and risk assessment, which are crucial for making informed investment decisions. Financial literacy also helps aspiring investors comprehend various investment vehicles, such as stocks, bonds, mutual funds, ETFs, real estate, and many more. Knowing how these investments work, their risks, potential returns, and how they fit into a diversified portfolio is essential for making informed decisions. In essence, financial literacy empowers good investors to make sound financial decisions, avoid common pitfalls, and build wealth over time. Skill number 2. Research and analysis. The ability to conduct thorough research and analyze investment opportunities is critically essential in becoming great at investing. This includes evaluating financial statements, analyzing industry trends, and studying competitive landscapes and other macroeconomic factors. When it comes to developing a research and analysis skill in investing, begin by defining your investment goals, risk tolerance, and time horizon, which will guide your research focus. Begin also with macro-level analysis, examining economic indicators, industry trends, and geopolitical factors to identify sectors poised for growth or facing headwinds. Next, delve into company-specific research, evaluating financial statements, including the balance sheet, income statement, and cash flow statement, to assess a company's financial health and performance. Utilize ratio analysis to gain insights into profitability, liquidity, and leverage. Combine qualitative analysis, such as management quality and competitive advantage assessment, with quantitative analysis, including valuation models and risk assessment tools, to determine a company's intrinsic value and potential risks. Stay informed by regularly monitoring news, earnings reports, and regulatory updates relevant to your investments. Continuously review and adapt your investment thesis and portfolio allocation based on new information and changing market conditions. Consider seeking professional advice when needed, especially for complex investment strategies or vehicles. Also, note that research and analysis are ongoing processes that require dedication and attention to detail to succeed as an investor. Skill number 3. Emotional intelligence. Emotional intelligence skills serves as a crucial asset in the realm of investing, aiding intending investors in navigating the complexities of financial markets with clarity and composure. One of the primary benefits of emotional intelligence skill is its capacity to help investors manage emotions effectively. By recognizing and regulating feelings of fear, greed, and impulsiveness, emotionally intelligent investors can maintain a balanced perspective amid market fluctuations, avoiding knee-jerk reactions that could compromise long-term financial goals. Furthermore, mastering emotional intelligence as a skill helps foster a deeper understanding of risk tolerance and investment objectives, enabling investors to align their decisions with their financial strategies. Emotionally intelligent individuals are better equipped to assess the potential risks and rewards of various investment opportunities, making informed choices that reflect their unique circumstances and aspirations. This self-awareness promotes a more disciplined approach to investing, reducing the likelihood of succumbing to impulsive or emotionally driven decisions. Lastly, emotional intelligence facilitates effective communication and collaboration, both of which are invaluable in the investment landscape. Emotionally intelligent investors can build strong relationships with financial advisors, colleagues, and other stakeholders, fostering an environment conducive to learning and growth. By cultivating empathy and interpersonal skills, they can leverage diverse perspectives and insights to enhance their investment strategies and decision-making processes. In essence, emotional intelligence serves as a cornerstone of successful investing, empowering individuals to navigate markets with resilience, adaptability, and wisdom. If you're new to this channel or you enjoy watching this video, don't forget to kindly hit the subscribe button to keep learning more stuff on this channel. In that way, I get encouraged to keep posting more helpful videos. Also, remember to tap the notification icon so you get notified as well. Awesome, let's proceed. Skill number 4. Risk management skills. Successful investors ought to understand and manage risk effectively. This involves assessing the risk-return trade-offs of different investments, diversifying portfolios, and implementing risk mitigation strategies. Risk management skills are paramount for investors seeking to safeguard their capital and optimize returns in an uncertain financial landscape. Firstly, a comprehensive understanding of risk allows investors to assess and quantify potential threats to their investment portfolios. By conducting thorough risk assessments, investors can identify and prioritize risks according to their likelihood and potential impact. This enables them to allocate resources effectively, focusing on mitigating high-probability, high-impact risks while managing lower-level threats proportionately. Such proactive risk management strategies help investors protect their capital and preserve wealth over the long term. According to George Soros, a Hungarian-American billionaire, he says, "It's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong." Furthermore, risk management skills empower investors to diversify their portfolios intelligently, spreading investments across different asset classes, sectors, and geographic regions. Diversification is a fundamental principle of risk management, as it helps mitigate the impact of adverse events on overall portfolio performance. By diversifying strategically, investors can reduce the correlation between individual investments, minimizing the potential for catastrophic losses while preserving the opportunity for meaningful gains. Effective diversification requires a keen understanding of correlation dynamics and asset allocation principles, enabling investors to construct portfolios that balance risk and reward in line with their investment objectives. Moreover, risk management skills enable investors to implement appropriate hedging strategies to protect against downside risk. Hedging involves using financial instruments such as options, futures, and derivatives to offset potential losses in the underlying assets. By hedging selectively, investors can mitigate the impact of adverse market movements without sacrificing potential returns. This allows them to maintain exposure to high-conviction investment opportunities while managing the associated risks effectively. Additionally, risk management skills empower investors to set clear risk tolerance levels and establish disciplined risk management protocols. By defining acceptable levels of risk upfront and adhering to predetermined risk management rules, investors can avoid impulsive decision-making and emotional responses to market fluctuations. This fosters a disciplined approach to investing, promoting consistency and resilience in the face of uncertainty. In conclusion, risk management skills are indispensable for investors seeking to navigate financial markets successfully. By assessing, diversifying, hedging, and setting clear risk tolerance levels, investors can protect their capital, optimize returns, and achieve their long-term investment objectives. Effective risk management requires a blend of analytical rigor, strategic foresight, and disciplined execution, empowering investors to navigate the complexities of the investment landscape with confidence and resilience. Skill number 5. Continuous learning. Investing is a lifelong learning journey. Successful investors stay informed about new investment opportunities, market trends, and evolving investment strategies through continuous education and self-improvement. Continuous learning is a foundational skill that empowers investors to adapt, evolve, and thrive in dynamic financial markets. Firstly, staying abreast of industry trends, market developments, and regulatory changes allows investors to make informed decisions based on the latest information. By cultivating a habit of continuous learning, investors can enhance their understanding of complex financial concepts, refine their analytical skills, and broaden their investment horizons. This ongoing pursuit of knowledge enables investors to identify emerging opportunities, anticipate potential risks, and adjust their strategies accordingly, thereby enhancing the resilience and agility of their investment approach. Moreover, continuous learning fosters a growth mindset, encouraging investors to embrace challenges, seek feedback, and learn from both successes and failures. By maintaining a curiosity-driven attitude and a willingness to explore new ideas, investors can expand their intellectual capital and develop innovative investment strategies. This not only enhances their ability to generate alpha but also cultivates adaptability and resilience in the face of uncertainty. And of course, continuous learning also fosters a sense of humility, reminding investors of the inherent complexity and unpredictability of financial markets, and encouraging them to approach investing with humility and intellectual humility. Benjamin Franklin once said, and I quote, "An investment in knowledge pays the best interest." And yes, of course it does. Furthermore, continuous learning promotes professional development and networking opportunities, enabling investors to build relationships with industry experts, mentors, and peers. Engaging in ongoing education programs, attending conferences, and participating in investment communities facilitate knowledge sharing, idea exchange, and collaborative problem solving. By tapping into diverse perspectives and insights, investors can gain valuable insights, challenge their assumptions, and refine their investment strategies. This collaborative learning environment not only expands investors' intellectual horizons but also fosters a sense of camaraderie and mutual support, enhancing their overall effectiveness and resilience as market participants. Alright. If you've enjoyed this helpful video, don't forget to hit the subscribe button to keep it locked on this channel. Also, remember to smash the notification button so YouTube notifies you when more helpful videos like this drop. Thanks for watching. See you in my next video. Bye.